Welcome to our market view presentation, where we will be analyzing the currency pairs of Euro and US dollar and Euro and Australian dollar. These are all the group members working on the presentation, starting off with Kira, followed by Sarah, and then Jetney. We will briefly state the development of the exchange rate of each currency pair of our choosing. Afterwards, we will analyze the currency pairs with the help of the following indicators, being the relative inflation, interest and economic growth rates, and the commodity prices. We will begin with analyzing the currency pair Euro and US dollar. You can see the development of the exchange rate of the Euro against the US dollar over the last 16 years. After the year 2000, briefly after the introduction of the Euro, we identified a strong appreciation of the Euro against the US dollar, up until the year 2009. This appreciation was also assisted by 9/11 that happened in the US. Due to the financial crisis and the Euro crisis, the trend was depreciated. The first indicator that we have used to analyze the currency pair of the Euro and US dollar are the relative inflation rates of the last few months. As represented in the chart, the inflation rate is significantly higher in the US than in the Eurozone. This leads to less demand for exports as the prices in the US become less competitive in the world market. Therefore, the demand for US dollar will be less. Furthermore, the demand for imports for the US will increase, as overseas goods become relatively cheaper on the US domestic market. This will potentially lead to an increase of supply of the US dollar. The conclusions in the previous slides lead to the US demand curve shifting to the left and the supply curve shifting to the right. As illustrated, these two effects will lead to a fall in the value of the US dollar, and the US dollar will depreciate against Euro as a result. The second indicator, which we analyzed, is the relative interest rate. According to the Reserve Bank of Australia, the nominal interest rate is 0% in the Eurozone and 0.38% in the US. In order to allow for quality assessment, we used the relative real interest rate. We did this by subtracting the inflation rate from the nominal interest rate. As depicted in the table, the real interest rate of the US are lower than the Eurozone.
Another indicator is the relative economic growth rate. As you can see on this slide, the economic growth in the US is relatively higher than in the Eurozone, according to the IMF. The first consequence is an increase in the demand for US imports, results from higher income. This leads to an increase in supply of the US dollar. The second effect is a rise in foreign direct investment, which increase the demand for US dollar. As a result of the conclusions stated before, the supply and the demand curve will shift to the right. As they shift in the same direction, it can be concluded that this indicator has a relatively weak or even no influence on whether the US dollar depreciates or appreciates against the Euro. Through the analysis of these three indicators, it can be said that the US dollar depreciates against the Euro. Now, we will move on to the second currency pair, which is the Euro and the Australian dollar. We will start off by explaining the development of the exchange rate for this currency pair. In this chart, you can see the development of the last 16 years. It is remarkable that the Euro strongly depreciates against the Australian dollar from 2009 after the financial crisis and in the first years of the Euro crisis. In 2013 to 2014, you can see an appreciation of the Euro against the Australian dollar, led by decreasing commodity prices and sliding economic activity in China affecting Australia's economy. The first indicator that we have analyzed are the inflation rate. Although one can see that the inflation rates of Australia are higher in all quarters, we focus on the second quarter in 2016. For this currency pair, we compared the data quarterly due to the RBA Bank only supplying quarterly data of the inflation rates.
Considering the information from the chart, we can see that the Australian dollar has a higher inflation rate in the second quarter than the Eurozone. This will lead to less demands for exports as the prices in Australia become less competitive on the world market. Thus, the demand for Australian dollar will be less. Moreover, the demand for imports will increase as overseas goods become relatively cheaper on the Australian domestic market. This will lead to more supply of the Australian dollar. Both these conclusions could potentially lead to a depreciation of the Australian dollar against the euro. This results in a change in the supply and the demand curve for the Australian dollar, leading to the demand curve shifting to the left and the supply curve shifting to the right. As illustrated, these two effects will result in a fall of the value of the Australian dollar, which means that the Australian dollar will depreciate against the euro. The second indicator is the relative real interest rate. The real interest rate of Australia in the second quarter of 2016 is relatively higher at a rate of 0.83%, whilst the Eurozone rate lies at 0.07%, encouraging capital inflow in Australia and therefore increasing the demand of the Australian dollar. Furthermore, this discourages capital outflow in Australia, decreasing the supply of the Australian dollar. This potentially results in an increase in the exchange rate equilibrium of the Australian dollar due to the shifts of the demand and the supply curve. Therefore, one can predict that the Australian dollar will appreciate against the euro because of this indicator. Our last indicator for the currency pair of the euro and the Australian dollar is commodity prices. The commodity prices have a strong impact on the exchange rates of Australian dollar. Due to Australia being a major exporter of commodities, Australia's key exports are coal, iron ore and natural gas. The IMF chart shows that the commodity prices index had increased in the last 2 quarters of 2016, especially led by an increase in prices of the bulk commodities. However, the IMF as well as the World Bank argue that most key commodities of Australia will decline in the upcoming month. For example, the World Bank predicts that the iron ore prices are going to decline by 10% in 2016. Due to the fact that prices of Australian key commodities are constant worldwide, a predicted decline in commodity prices will decrease the value of Australian exports, resulting in a slight depreciation of the Australian dollar against the euro. Although the indicators don't all lead to the same conclusion, we predict through the analysis that the Australian dollar will slightly depreciate against the euro in the next 3 to 6 months. We have now come to an end in our presentation. Thank you for listening.